Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Look, our mission here is simple. We give you the unvarnished truth. We stress test company balance sheets, and we find the structural integrity, or, the fatal flaws that everyone else seems to miss. Today, we're putting a true market giant under the microscope. PayPal, a name that's basically become synonymous with online payments, a company that was for years a fortress of growth. But that fortress just showed a massive crack. And we're here to figure out exactly why. On February 3rd, right after they reported their fourth quarter earnings, PayPal's stock got absolutely hammered. I'm talking a drop of over 15% in a single day. Now, let's be really clear about what that actually means. This is not some minor dip, this is a seismic shock. This move wiped out more than $9 billion in shareholder value in just a few hours. This is the kind of event that sends shockwaves through an entire portfolio. The market didn't just dislike the earnings report, it violently rejected it. Which brings us to the immediate burning question every single investor should be asking. Why? I mean, what on earth did the market see that was so terrifying? Exactly. It makes absolutely no sense if you're just looking at the surface. You see a household name, you hear chatter about growth, and then you see a stock price that looks like it just fell off a cliff. It's confusing, and honestly, that confusion is what leads to really costly mistakes. That's why we're here. So today, we are going to conduct a full forensic investigation. First, we'll examine the collapse itself. Then, we'll look at the company's official story, what I like to call the solid earnings facade. After that, we're getting our tools out, and we're going to look for the cracks in the foundation. We will identify the forward-looking storm that caused the real damage. And finally, we'll deliver the Iron Financial verdict. Is this a structural collapse, or is this a rare buying opportunity? Let's dive in. Okay, let's get right into it. We have to start at the crime scene. A drop of over 15%. Now, in the world of large-cap stocks, a move like that is a five-alarm fire. It isn't just a simple reaction to a number. It signals deep institutional panic. It tells you that the major funds, the ones with entire teams of analysts digging through every single line of a report, found something fundamentally, deeply wrong with the company's story. Yeah, they didn't just sell, they fled. And our job is to figure out what they saw. And that right there, that's the core of it. It's the paradox that traps so many investors. Most people, they'll glance at the headline numbers. They'll see words like growth and profit, and they're left completely baffled by the market's reaction. They start thinking, oh, the market must be irrational. But here's the thing. The market, while it can be emotional, is rarely this irrational on this scale. It's reacting to something much, much deeper. So to solve this, we first need to scrutinize the official story that PayPal presented to the world. We need to examine their alibi. All right, let's talk about that alibi. On paper, if you're looking strictly at the fourth quarter results, the story PayPal told looks airtight. The numbers, if you take them in isolation, they paint this picture of a really healthy, growing company. This is the blueprint PayPal's management team wanted every investor to focus on. They presented a solid, well-constructed facade that was designed to inspire confidence and project strength. Okay, so let's look at the numbers they were so proud of. And here it is. Here is that solid facade laid out in black and white. And you can see the numbers do look strong across the board. Net revenues up 4% to almost $8.7 billion. GAAP operating income, that rose by 5%. And total payment volume, which is really the lifeblood of the company, grew by a very solid 9% to a staggering $475 billion. But the real showstopper, the number they want to plastered on every headline, was the GAAP earnings per share. It jumped by a massive 38%. So on the surface, no, these are not the numbers of a failing company. This looks like a solid, well-built structure. Yeah, let's just isolate that headline number for a second. 38% growth in earnings per share. In almost any other environment, for almost any other company, a stock would rally, and rally hard on this figure alone. It suggests incredible profitability, incredible efficiency. It tells a story that for every single share an investor owns, the company is generating significantly more profit than it did just a year ago. Based on this number, the foundation looks like it's made of solid granite. Hold on. Stop right there. This is exactly my point. These numbers are the shiny marble facade on the front of the building. And yeah, it looks impressive from the street. But a 15% demolition tells me there are deep, foundational cracks that the architect is desperately trying to hide. The market didn't just chip the paint here, it took a wrecking ball to the whole structure. So is this all just hype, or is it real? What critical piece of information is missing from this pristine picture? What aren't you telling me? That is precisely the right question to be asking. The market, the professional traders, they saw right through that facade. They knew exactly where to look for the structural weaknesses. So our investigation now needs to drill down, way past the headline numbers. We have to examine the footnotes, read the management commentary, and look at the underlying operational metrics to find those hidden clues that pointed to a building that was, frankly, fundamentally unsound. And the first clue, the first visible crack, it comes directly from the mouth of management. On their earnings call, the CFO, Jamie Miller, made this critical admission. Read it carefully. What she's saying is that people are still using PayPal, but they are spending less money each time they do. So the average order value is going down. This is a massive red flag. It is a direct signal of weakening consumer health. It suggests that people are either trading down to cheaper things or they're just cutting back altogether. You have to remember, PayPal is on the absolute front lines of consumer spending, and this comment was a distress flare. Okay, now we're getting somewhere. So the consumer is weakening, but it's not just that. When you dig deeper, you start to see more and more warning signs. For example, active account growth has slowed to a crawl, just 1.1%. So they aren't adding new users at anything like the same clip. And that's a huge problem for a company that's supposed to be a growth company.
Exactly. And what's more important, their existing users are becoming less engaged. Payment transactions per active account actually decreased by 5%.
Wait, hold on. So not only are they growing slower, but their core existing users are using the service less. That's a really bad combination.
It gets worse. You've got a major leadership shakeup with a brand new CEO, Alex Chris, taking over right in the middle of all this uncertainty. Then you add in operational problems like that service disruption in Germany that forced them to set aside money for losses, and the picture gets a whole lot darker. These are not minor blemishes. These are serious load-bearing cracks.
Precisely. Any single one of these issues, slowing growth, lower engagement, a CEO transition, an operational hiccup, the market might just dismiss it as a temporary setback. But when you see them all happening at the exact same time, it paints a very cohesive and frankly disturbing picture of a company that is losing its momentum and facing some severe internal and external headwinds. The foundation is decaying. But even these cracks, as serious as they are, they don't fully explain the violence of that 15% collapse. There had to be one more piece of evidence. There was a smoking gun. All right, I'm with you. We found the cracks. But what was the final blow? What was the one piece of evidence that just blew this entire case wide open? What did the market see that transformed all this concern into outright panic and triggered that massive sell-off? Let's see the smoking gun. This slide, this says it all. This is the entire case in one single image. You have to understand, the market doesn't trade what a company did. It trades what a company is going to do. The past, as we saw, was that beautiful 38% gain in earnings per share. But the future, the company's own official forecast, their guidance for the full year 2024, was for a mid-single-digit decline in GAAP earnings per share. Exactly. PayPal's own management team stood up in front of the entire investment world and basically told them that the good times were over and that profitability was about to go backwards. So here's the crucial point. This is the motive for the crime. The market completely, utterly ignored the Q4 earnings report. Why? Because that was a look in the rearview mirror at a sunny day. The guidance, on the other hand, was a look through the windshield at a cliff dead ahead. That guidance wasn't just a forecast. It was a total demolition of investor confidence. The company itself confirmed every single fear that those underlying cracks suggested. And this just brilliantly illustrates the treacherous environment where this bombshell landed. This didn't happen in a vacuum, in a calm and forgiving market. As you can see from the broader market data, this is a choppy, nervous environment. And critically, we have plunging consumer confidence, which has fallen to its lowest level since 2014. In an environment like this, a company has absolutely no room for error. So weak guidance isn't just a red flag, it's like a blaring fire alarm in a crowded theater. The market didn't wait around to see the smoke, it stampeded for the exits. Okay, so we've done the work. We've investigated the crime scene, we've examined the company's alibi, we've found the deep cracks in the foundation, and now we have positively identified the smoking gun. The case is pretty much closed. But for us as investors, the real work is just beginning. What's the final verdict? Now that the building has collapsed, is this an opportunity to buy the rubble on the cheap, or is it a dangerous trap for investors? Our verdict at Iron Financial is clear. This is currently a trap, not an opportunity. First, you absolutely must acknowledge the damage. The business is fundamentally slowing down, and the foundation is far, far weaker than those headline Q4 numbers would have you believe. Second, you have to appreciate the heavy lift that lies ahead. The new CEO, Alex Chris, doesn't just have to steer the ship. He has to undertake a massive rebuilding project to restore growth and, just as importantly, restore investor confidence. And that leads to our final and most crucial step. Wait for the blueprint. You don't buy a pile of rubble and just hope it becomes a skyscraper. You wait for the new leadership to present a credible, detailed plan for reconstruction. Until we see that plan, stay away. So the real takeaway for our viewers is this. You absolutely cannot invest by just reading headlines. The market is a forward-looking machine. You have to be willing to dig into the foundation, to look at those underlying metrics like user growth and transaction size, and most importantly, you have to listen to what the company itself is telling you about the future. PayPal told us the storm was coming, the market was right to listen. This is now a classic show-me story. The burden of proof is entirely on PayPal's new management to show us they can actually rebuild this thing.
And that really is the multi-billion-dollar question, isn't it? I mean, PayPal built its entire global empire on one single core concept, trust. Trust that your payment would be secure and trust that the business was strong and always growing. Now, with a new CEO, a shaky economic outlook, and their own forecast pointing straight down, that trust has been severely damaged. Rebuilding it will be a heavy, heavy lift. For now, we at Iron Financial are staying firmly on the sidelines, watching and waiting until we see a solid, credible new blueprint for the future. Thanks for tuning in to Iron Financial.